showcase. This is a quarterly event. This is Sherry, of course, your hostess. And this is a quarterly event where we feature expert traders to bring you trainings, tips, hints, and insights from many speakers. This time we happen to have 20. Prize giveaways. We've had some stellar prizes given away. Please check out TradersExclusive.com where we put up our posts and our articles and video clips that have nuggets, golden nuggets for you to learn new trading tips and techniques. And hopefully I will not be this tongue-tied the whole day. This is also where you're going to find recordings. I'll have the recordings up potentially over the weekend. So by Monday, we'll definitely be looking at having them all up there, but they'll be dribbling in over the weekend. Before I get started, I do have to do the disclaimer. In order, you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance, of course, is not necessarily indicative of future results. So please take notes with a little bit of context and hold your questions until the end, please. But then we are also going to see now Michael Guess of, sorry, Michael, two more things. I had two more, I've got things memorized and I've got two more slides to go. This is our lineup for today. Michael, Daniel, Kenny, AJ, Michael again, Harry Boxer. We're not going to be doing anything at the 4 o'clock hour. We were working on a segment and it wasn't quite ready, so we're going to unveil that in 2024 for happy hour roundtable situation. Then if you need to reach me, it's support@tradersexclusive.com. And I want to thank our December sponsors. We have blue chip sponsors, Market Taker Mentoring, Hit and Run Candlesticks, and Vantage Point Software, Vantage Point AI. And also Mumu was one of our sponsors this month as well. So without further ado, and thank you for bearing with me, Michael Guest of TradeSafe LLC, daytradesafe.com. It's day trade part-time from home, the lazy way. I kind of like the easy way too. So I'm really looking forward to this presentation. Michael began his trading career more than 30 years ago when he started trading NASDAQ stocks as a SOES trader in what were known as prop shops. He eventually migrated to trading directly to the pit for the S&P 500 index when a point was worth 500 bucks. When the first M&E contract was created, he had already developed the foundation for what was to become the TradeSafe system. As president of a nationally recognized trading group in Austin, Texas, Austin Association of Financial Traders, he was often approached to teach his methodology. And over the years, he has coached more than 2,000 students from all around the globe. Throughout this period, Michael has developed mechanical systems and tested scores of trading tools such as charting programs, data feeds, the first electronic order entry platform, and virtually every type since then. Several times a year, he has taught a day trading course at a major university. Michael has also been an entrepreneur owning several businesses. His background as a therapist and trainer equips him to offer cutting-edge tools that traders can use themselves so they can maintain diamond-hard discipline in their trading. Michael is dedicated to providing the most comprehensive array of trading resources you can use to transform your current trading into a successful trading business, the TradeSafe way. Thank you for joining us, Michael. I really appreciate it. I'm super happy that you could. Let me just do a little bit here where I can hand you the presenter status so you can share your screen. And I see that your mic is unmuted, so you should be good to go.
And thank you, Sherry and Traders Exclusive, for this great opportunity to try to share a few tips, tricks, and tools with the rest of you. So, hey, traders, thank you. The market's open. And what I would like to do is, first of all, show you how, in spite of all of the irregularities we've been experiencing for the past year or two, high volatility, crazy economy, global inconsistency, that you can actually achieve the mythical holy grail. It's actually consistency, not some kind of rocket science indicator or anything like that. It's consistency. You need to run your trading like a business, but to achieve that, you want to replace your subjective trading. That's discretionary in another word, with getting consistency. And the way to do it is using what I call a mechanical trading system. It's a Boolean logic approach, and for the most part, it's going to be automated. But what I'm going to do today is, this is not a pitch fest. I'm here to share a lot of the most important components that I think you can take away and start playing with and start finding out for yourselves how well it works. So first of all, let me go ahead and show you who I am. That's me. And I want to say thanks again. And I'm here to show you that in spite of volatility and inconsistency, you can achieve consistency. But you've got to modify your approach to trading. You got to be able to filter out the volatility. You got to be able to smooth the uncertainty. And of course, how do you do it? Let's start off with the first tip. Please don't trade with a single chart. Don't do that one size fits all. Doesn't work. You need to use more than one chart with higher and higher settings. These are called time frames. Now, they're not just any setting, like the drop-down menu in your day trading platform, for example. They're generic and pretty much useless. What I do is I have done research and I've found cycles-based settings that actually work very well. And I'm going to give away to you a little formula on how you can determine the settings for any individual market. So the next thing is, you want trend agreement. Once you've got more than one chart, everybody just thinks in terms of that smallest chart for the low risk surgical entry. What you want is a higher and a higher, and the more of those charts that trend in the same direction, you got a lot of wind at your back, and you are going to get more follow through. The probabilities go up when you do that. But these chart settings are going to depend on how long your session length is. So if you trade, let's say, the S&P, Dow, NASDAQ, Russell, any of those indices, the typical day session is going to start at Central Time in Chicago at the exchange, 8:30, and it'll end at 4. What you want to do is take the number of minutes and start dividing with smaller and smaller and smaller settings. Now I start with 405, which is the old setting when it was 315, and I found there was negligible difference when they switched it to 4 o'clock. So starting with 405, what's the next smaller setting that divides into 405? I'll save you the trouble. 135. Next smaller, it's going to be 81. These are not numbers people think about. And the next smaller setting is 27. And as we keep going down, I want you to keep in mind you want a 3-to-1 ratio. And you'll find out very shortly why that's critical. What is 1/3 of 27 that also divides into 405? 9. Boy, that's an odd number, isn't it? How many of you have ever thought of a 9-minute chart? And 1/3 of that is a 3, very common. And 1/3 of that is the usual 1-minute chart that a lot of you use for entering your low risk surgical trades. Okay? So that is the way that I encourage you to consider. But you must use this on trending markets. My approach is for trending. It's the easiest approach to trading, quite frankly. If you want to learn how to make money easier and not struggle, use a trend following approach. My system is trend following, even though I prefer to use futures and commodities. That's only because I've found that day trading doesn't terribly work well on Forex. It's better suited for, I think, swing trading. Stock market, of course, it's afflicted with high frequency program trading, specialists who dominate the market. And of course, there's all kind of little rules and things about whether you can take the trade, uptick rule, optionable, and so forth. Plus, it takes you $25,000 to just play ball if you want to day trade. It takes far, far less, just a few $100 if you want to start day trading in the futures and commodities markets. So, here's a tip right away. I'm going to give you a bonus. If you want to try day trading in the approach I'm saying, in my course that accompanies my system and software, I include a method that shows you how you can repurpose your day trading and turn it into a swing trade. Instead of using, say, one or two contracts, you're going to use sets of three, and contracts are the unit of measure for futures and commodities, just like shares of stock, for those who don't know. Now, if you are going to be doing three contracts, you want to be able to enter, take the first third off at a quick and easy to reach position, or rather target, and then you got a paid for trade. And as long as you don't get stopped out, you ride it to the close. If you make it that far, trailing your stop, and I'll show you a method to do that a little bit later, then at the close, or just before, frankly, you're going to take off the middle third. Then change your stop till good till cancel so you're protected overnight. And then in the morning when you wake up, if you're still in the trade, then what you're going to do is bump it up to the next higher time frame that's in agreement. Now, we don't use a 1 minute chart to enter anything that you're planning on turning into a swing trade. That's too small. Start with a 3. And then when the next day occurs, bump it up to a 9, because that'll give you far more breathing room for trailing your stop and keep you in the trade hopefully for several days. So I hope you enjoyed that. Now, how do you pick the best markets to trade? Well, they have personalities. A lot of beginners make the fatal mistake of thinking, oh, they're all the same. No, they're not. Just like indicators are going to work on every market just the same way. No, they won't. They have personalities just like you and I do. And as a former psychotherapist, I've learned how people behave around the markets as well as how the markets themselves, which reflect the personalities of the people trading them, behave. So here's a couple of examples. The indexes already told you, S&P, Dow, NASDAQ, and Russell. Recommend those. They're inherently trendy. Of course, the currencies are quite trendy. So that'd be a good starting point. But above all, don't try to trade markets that don't have inherent trending characteristics. Now, I know gold and crude are very popular, but they're not inherently trendy. They have a tendency to congest, and if you get a breakout, they don't always keep going. What will often happen is they'll come right back into congestion and you will be stopped out. So I would recommend starting with something that has a trending personality. Now, if you're going to be using the indexes, right away I'm giving you the settings that we use in our TradeSafe system. And that is, think about a camcorder or any camera that has a zoom lens. You want that wide angle view of the market. You want a half day or a full day's view of the probability of trending, and that's your 9-minute setting. Anything above that is really not appropriate for day trading purposes. You might want to consider it for swing, but 1/3 of a 9-minute is your dominant 3-minute cycle. But you want the lowest risk. Keep that reward risk under control, don't you? You heard what Rick said. Keep your risk under control. So I recommend the 1/3 of 3 is a 1 minute. A lot of us already do that. But I put in parentheses there, tick-based. Why? A tick chart, some of you don't know what that is. I'm not here to try to educate you all of technical analysis. But instead of time, it's more, think of it as trade-based. How many trades occur for whatever setting you have for your bar. Now, I have seen in high volatility conditions, one of the indexes, especially the NASDAQ, which is inherently volatile even before it got crazy, uh, 1 minute risk levels that were as much as $500-600 or more in the span of 60 seconds. That's too much. Once you find out how small my risk levels are, you'll be amazed that you don't get stopped out very often at all. Now, if the risk levels are too high for a 1 minute chart trade, we offer you settings for tick-based charts. Now, you're free to experiment on your own. You may want to start with some kind of fib or GAN number setting like a 144 or 233. Now, as we go further into this presentation, you will find out, well, how do I use that? So bear with me. Keep this in the back of your mind. The more charts that are trending together, up or down, the more likely you're going to have a winner and a big follow through. So strength of trend is what you're after. Strength of trend is going to set you up for how you want to manage and exit your trade. Whether you want to get out real quick because it's a weak trend or hang in there for the long haul because you've got all these charts trending together. And I'll show you exactly how you can determine that. Okay, so let's keep going. So risk, I mentioned that volatility is going to create a lot of risk. During volatility situations, people may not know what that means. It simply means the bars are updating frequently because there's huge order flow, more than normal, and during the span of time, those bars typically grow bigger than average. So you're going to get a bigger bar, bigger risk. That's basic. You will want to switch to a tick-based chart if that's the case, as I made the case earlier, instead of using a 1 minute chart. But if you choose a tick chart for entering your trades, you still need basic trend agreement to determine strength of trend between the 1 minute chart and the 3 minute chart. That tick chart must trend along with the 1 and the 3. Now I'm going to give you a little rhyme, a mnemonic that helps my students remember the basics about, oh, okay, well, how do I determine which exit strategy to use? It goes like this. The 1 and the 3 must agree. Best is if all three agree, the 9, 3, and 1. So if you're trading a tick chart, you want it to at least agree with the 1 and the 3. Real simple. So these exit strategies that come with our system are already set up for you, but you can create your own. You can create what is known as an ATM, an automated trade management exit strategy. If you use a professional platform like NinjaTrader, highly recommended. I'm not married to them. I don't get any reimbursement for recommending them. It's just I found them to be the best. I use NinjaTrader to create ATMs, and they let me create automations so that you can keep your hands off your mouse and it will manage and exit the trade for you. So if you got a very, very weak trend, I'm going to use a baseball metaphor. If it's a sloppy pitch, you're going to bunt and get on base. At least you got on base. You didn't get struck out. That's what a scalp is. Go for a few ticks. More than 3 or 4 at least, because otherwise you're in noise. And that's if only the 1 minute and the 3 minute chart are trending together. You have a little bit of wind at your back,
Order canceled.
enough to take the trade and say the risk is going to be acceptable. On the other hand, if all three agree, the 1 minute, 3 minute, and 9 minute chart agree, then what you can do, pardon me, is use an exit strategy called scaling out. This way, you're going to probably hit a similar target like a scalp if it's medium strength as far as trend. And I actually provide 3 exit strategies, a scalp and 2 different levels of scale out targets. Pardon me. But when you hit that target, whatever it is, you're going to take off half of your position, and that'll pay for the trade. And then after that has occurred, totally sit back, relax. You don't have to do anything because you will be able to trail a stop automatically. The ATM will allow you to do that. You don't have to be subjective. You don't have to listen to all those voices in your head from everybody you've ever heard about, well, do I get out here because of this or that? Forget it. Let the system work. Okay? Now, here's another bonus that I'm going to highly recommend that prevents letting potential winners turn into losers. Let's say that you hit the target, but it didn't go through it and you didn't get the fill. Oh, phooey. Price came back and you got stopped out. That's very frustrating and it's kind of hard to keep going. So I recommend that if your software permits it, NinjaTrader does, you set up an algorithm that's part of your exit strategy, part of the ATM, that has a trigger point. It might be the target itself. It may be a little bit sooner. You can experiment and find out what works for you. What happens when you get to that trigger point? An order occurs. You don't get filled on anything. This order simply takes your stop from where you could have had a loser and moves it to where you entered. Break even, that's what the BE stands for. Plus, move it a little bit further to one tick of profit. That extra tick of profit is going to cover your commissions and or slippage. I build that into every single one of my exit strategies, and I highly recommend you do the same. So to recap on scalping for weak trends, you're going to enter with however many contracts, whether it's 1 or 10 or whatever it is, and exit with the same number. Nothing fancy. Get in, get out. The little BE1 thing will occur along the way to hedge your bets, so to speak. But if you're going to scale out, however many positions there are, need to be combinations of 2, 4, 6, 8. Needs to be divisible by 2 so you can take off half your position at that target and then begin to trail your stop. So once you've determined that, I'm going to now give you the 4 basic steps to entering what I call a TradeSafe trade. And the first thing you've already heard me say, determine the strength of the trend. Use a for real indicator, no higher highs and higher lows. That's BS. It's subjective. And I could get 6 traders to give me 6 opinions about, oh, the trend started here or there. Get a reliable trend indicator. In our system, ours not only does that, it indicates whether you're in congestion or not to keep you out of trouble. Plus, it not only shows you whether you're in a trend or congestion or not, your computer will even talk to you in plain English and tell you. So if you're not there and you're in the kitchen fixing a sandwich, or you got a hidden chart and you want to know what's going on there, your computer will inform you. So once you know your strength of your trend, at least the 1 in 3 agree, best as if all 3 agree, set up your ATM exit strategy. Don't do it after you've started the trade. That's too late. Do it before. Then the second step is now it's legal to start prospecting for an actual setup. And a setup is basically something that's as old as dirt, except that I have refined it with real rules, so it's very, very consistent. And that's a pullback, a retracement. And you want the bar that's deepest in that pullback, that's called a setup bar, to have certain conditions met, which I will spell out for you a little bit later. And then you want independent confirmation from something else. You don't want to depend just on that step 2. I recommend picking some oscillator, RSI, CCI, stochastic, I don't care. I use a highly modified oscillator, and all I want is overbought or oversold. Now, it won't put you in the trade. I know a lot of you are accustomed to that. Oh, I've used oscillators in the past. When it gets out of overbought or oversold, I punch in. No, that's quite subjective, frankly, because it'll go right back in many, many times. All I need and all you'll need is overbought or oversold. Once you've got these 3 things, your final thing before that setup bar finishes and you park an order is make sure that risk is within tolerance. And I'll tell you what those risk levels are and how to achieve it as we continue. So, Step 1, to recap, determine the strength of the trend with a real indicator that is reliable, and make sure that you are doing that on all of the charts to determine how many of them are trending together, the 1, the 3, and the 9, however many of them. And if you enter on a tick chart, that's got to be in the same direction as they are. And then you set up that ATM, as I've told you already, before you enter the trade. Weak trend scalp, stronger trend scale, and it's all, frankly, based on the strength of the trend. Now, what's the step 2? Let's go into a little more detail. Let's dig in. A pullback or a retracement is nothing more than a very brief counter-trend pullback. It doesn't change the trend. You're still in the trend, up or down, but it's going to stop ideally at an EMA, exponential moving average, with a setting of 21. Now, I do have tolerances I'll get to in a few moments. Your setup bar itself is the bar that is the one that went the furthest in that pullback, the deepest bar in the pullback. And it ideally touches that 21. But if it doesn't quite reach it, or if it overshoots on the other side of the 21, that's okay, as long as it's within a very small tolerance. Now, we have rules-based tolerances. You will want to experiment with your own to find out what works for you. I can't give away everything in my system, let's admit that. And also, I highly recommend that the pullback itself be crisp and direct, about a 45 to 90 degree angle, no meandering around. Okay, that's the best way to do it. Moving on to this third step is the independent confirmation that you get from an oscillator, and you just need overbought or oversold. And as I've said before, when it gets out of overbought or oversold, it doesn't put you in the trade. All you need is get into overbought or oversold and then check your risk. So risk is going to depend, frankly, on what the average size of the bars are for the market you're trading. If the average size of the bar is too big, like I told you, a 1-minute bar on the NASDAQ, sometimes it gets really big. Well, that may not work too well. So if you're going to use the indexes as a starting point, here are the risk levels we use in our actual TradeSafe system. $70, and this is on a per contract basis because I don't know how many contracts you might be trading. And if you're scaling out, a maximum of 100. I do not use fixed dollar stops. If that setup bar is small enough, because how do you determine risk? From where you would enter to where the stop loss is placed. And I'll tell you in a little bit exactly where those points are. But from entry to stop loss, that is classically the risk. If it's over $70 on that bar, you cannot scalp. Over 100, you cannot scale. So we use what are called logical or variable stops. That means if the bar is small enough, you don't have to use a maximum of 70 or 100 for scalping or scaling. Just use whatever that smaller risk is. I have taken many trades where I scaled out with risk levels on a per contract basis of only $35. I know that seems amazing. You probably say, oh no, man, you're going to be stopped out. I'll tell you something. Here's a little brag, if you will. For the last 5 years, 87% of my students, for the last 5 years, 100% of my students have achieved at least 87% winning trades. And you can do the same thing too, because logical stops with rules-based approach and guardrails, like I'll teach you, will help you keep that risk under control. And finally, that recap, that's on a per contract basis. So here is a little illustration to make it all hopefully come into view. Let's say the trend is down and you're going to look for a sell. And here's the lowest point in the price move before a pullback occurs. And the pullback, I have to keep clicking my mouse because when you're on PowerPoint, the cursor disappears. There it goes again. It retraces. There is your retracement, bar by bar, towards what? That moving average. And the bar that went the deepest isn't this one. That's as high as it went. Now, you may say, well, what about this candle? No, the wick went even higher. So that's the deepest bar in the pullback. That's your candidate. That's your potential setup bar. And what you want to do, if all 4 steps are fulfilled before that bar finishes, don't wait till it is or you'll miss the entry, is you're going to park an order 1 tick underneath that bar's low. If it's in an uptrend, it's the other way around. You'll put an order in a tick above the setup bar because the pullback is going down, and you would park your order a tick above. All right? And I'll tell you later what kind of order. And then all you're waiting for is price to trade on through that order, so the exchange will fill the order because it needs to go through it. And that way it's like a rubber band. You've stretched it back and you got all this built up energy, and then the market snaps back in the direction of the trend. That way you are going to get the follow through. Let the market prove itself. All right? So let me go ahead and click on this so I can move to the next one. And this is a longer term screenshot on what you could expect if you set things up this way. Here's the same setup. You know, the trend was down. You had the pullback, the bar that was deepest in the retracement, which ended up becoming a pivot after you entered the trade. And that's what those dots represent, is a swing high or pivot. It's a resistance level. And then you would have parked your entry 1 tick underneath that bar. The very next bar would have traded through it. Consequently, you would have entered the trade and started heading lower. Now, if you have a BE plus 1, break even plus 1 tick of profit algorithm included in your ATM automated trade management exit strategy, then wherever that kicks in, then your stop is going to be moved from up here where you could have had a loser to where you would have entered, and 1 more tick of extra profit to compensate for slippage and or commissions. Then as you continue onward, if you're scaling out, because that's what this is, a scale out, you would hit a target. Let's say it's down here. Half your position comes off the table. And that way, you will be able to have a paid for trade. You're totally relaxed. You're very happy. And then you begin to use the trailing stop indicator. Now we have one built right into our system. I know what you think this looks like, but it's a highly modified version of it. I'm not going to say specifically what it is. You can use however you want to, some method of trailing a stop, whether it may be a parabolic, or you may want to include something that's built into the exit strategy choices, regardless. But notice the way I have mine set up. As the market headed down, it stalled out here and went sideways. See that little box there? It was going into congestion. Notice that price came right on down, and because we use a 1 tick offset so that touching those doesn't take us out of the trade prematurely, you're still in the trade. And then it broke out and kept right on going. Same. And it really picked up speed here. A lot of momentum, and consequently, this trailing stop kind of kept its distance from where the market action was. That gave breathing room so that the trade could continue. Eventually, the trade started to backfill enough and go through and hit your trailing stop. That let your system take you out of the trade. Real straightforward. That right there was about an $820 trade in approximately 20 minutes using just a simple 4 lot. You took 2 off at $50 and then you trail the rest. Nice. So let me go ahead and move forward here. Now, I'm going to break it down into the simple steps again, just to recap and reinforce what I've said so far. Step one, you got to have trend agreement. The 1 and 3 need to agree, best as if all three agree. Include the tick charts. Next, you can start prospecting for a pullback or a retracement following the rules. Specific number of bars, specific distance from the 21 or touching is better, etc. Independent uncorrelated confirmation from an oscillator, just overbought or oversold, and then finally keep your risk under control. And I already told you about how we manage our risk and how small those risk levels are and why we don't get stopped out. So, what kind of order do you use? If all those conditions are met and the bar is about to finish, well, if you're on a 1-minute chart, wait for the final 3 or 4 seconds. Don't wait for it to finish. And then park a stop limit order. That way it eliminates slippage. If you're on a tick chart, let's acknowledge that on tick charts, even if you're watching the tick counter getting down to 0, you don't know how many trades are coming down the pipe and what the next order is going to be. So if you have what I call normal order flow, it's not super high volatility, usually 15 to 20 ticks before 0 works well. This is something you're going to have to work with on tick charts. Now in my course, I teach you much more explicit methods that give you very reliable entries. Now, you park that order, as I said, a tick above if you're going to go long, a tick below if you're going to go short, and that pullback
Order submitted.
Very much like a stretched rubber band. You are just waiting for the snapback to go through your order and put you in the trade. And that way, you are going to be relaxing because it's hands-off time. You are on full automation in my system. It will take over and manage your trade. And what I've taught you, you can do the same thing. So let the system manage and exit your trade. And as a former psychotherapist, I cannot tell you how critical discipline and trading psychology is. And by putting the guardrails of using true systems and automation in place, you have a much higher probability of not screwing up. And of course, when the trade is over, the last thing you want to do, journal the trade. Professionals, they journal. What does that mean? It means you want to put, now mine is pre-formatted, both digital and hard copy, but what it means is you want to know why the trade worked and didn't work. Don't jump to the next trade and the next trade and the next trade. That's what amateurs do. You want to make sure that you know why it didn't work so that you can learn from it. And of course, use context. What the heck is context? Context is anything that's not part of those 4 steps, the system that I told you about. An example would be support or resistance. Let's say you got into a trade and there's some kind of support or resistance between your entry and your target. Let's face it, your odds, your probability are going to go down because there is some barrier between you and your target rather than nothing at all. What other kinds of context would you be wanting to consider? Well, don't try to trade during economic report releases. That's suicide, or even going into them or coming out of them. Another would be there's not enough volume to get a fill. I don't use volume in my system at all, but at least common sense lets you know, got to have enough volume. And I'll tell you what that is if you participate in my course. And another type of context would be, hey, no trend lasts forever. These trends sometimes get overextended. I will show you in my course, by the way, precisely what overextension would be for a given market. So, finally, and this is the most critical thing of all, once you've gotten this far and you've been taking all those trades, obviously you want a sim trade to build up some kind of an awareness of what works and doesn't work with your journaling, and you use a spreadsheet to track the actual stats so that when benchmarking comes, you will be able to know what conditions worked. Which chart was the best one to enter on? Was it the 1 minute or one of the tick charts? Was it one of the exit strategies specifically? I review benchmarking with a statistically viable sample of trades where you, instead of taking every trade like you did before, you will get to pick and choose the best of the best and leave the rest. So this will give you an authentic track record that you can take to the bank because you will know from everything you've done up to now what works. And just like engineers know what a benchmark is, traders need to establish a benchmark for whatever market they are trading, because what it does is it'll calibrate your software, your system to you, the human side, the emotions, the subconscious that self-sabotages you most of the time. And this is going to help you because you had previously journaled your trades and you learned what worked and did not work. And the benchmarking will reveal how you can reverse engineer and keep that working with real money. And that's how it works. So your best combination of what chart and what ATM, as I've mentioned already, in the last 5 years since I've been collecting these statistics, every single graduate in my course got at least 87% winners. Some of them win in the high 90s. That seems amazing, I know, but it is a fact and it is documented. So, with that being said, I want you to be confident, and I realize that we've still got plenty of time left. So I'm actually wrapping things up a little bit quicker than I expected. I would love to take some questions. If Sherry's there to give me some of those questions, let me know.
Okay. All right. Well, I was over here being muted. I have Victor asking, could you please explain in detail how to determine trend strength?
1 minute and 3 minute and 9 minute charts. I have a rules-based approach that I highly recommend you duplicate. You can do it. If only a 1 in 3 agree, that's a weak trend. It's still trend agreement. And if it's a weak trend, you may have come in late and missed that part, you might want to scalp. Okay? If all three agree, and you're trading the indices, for example, 1, 3, and 9 minute agree, you got much stronger trend. The wind is at your back. Swing for the fences. Scale out. That is how you determine the strength of the trend. Of course, you must use an actual trend indicator on each chart. Do not try to do that amateur thing called higher highs and higher lows. That's ridiculously inconsistent. Use a real trend indicator. Hopefully that answered your question. If not, come back with another. Go ahead.
Now, he also wanted to know, wouldn't the BE +1 take you out very early?
It depends on how close to your entry you are because there's noise within the first few ticks of your entry. Very good observation. I can't
Nice.
tell you specifically because it's built into my system, but you will want to sim trade and experiment with where you want that trigger point to kick in and move your stop. Because remember, whether you get filled or not on your execution of your target, at least if your stop got moved to break even plus 1 tick of profit, you will have a winner, albeit a quite small winner. If you're trading a 4 lot, you'll have a $20 winner. I hope that answered your question.
Anybody have any other questions?
Oh, I really welcome the
Raheem
questions.
said, very interesting presentation
Well, thank you.
today.
I've
Oh,
been
I have
doing this a
another one.
long
Does
time,
your
folks.
system work to trade stocks?
Pardon? Could you repeat it?
Does your system work to trade stocks.
Is there a system to trade stops? I'm not
It
sure I
says no, he's saying, does your system work to trade stocks?
Oh, stocks. I said that at the beginning. It
Sorry about
does.
that.
However, I strongly recommend against trading the stock market. First of all, and I might as well go into this in a little more detail, you need 25,000 just to day trade the stock market. A lot of people don't have that. You need 500 or 1,000 to open a futures or commodities account. Second, tax time. Let's say you are one of the lucky few who made a whole bunch of money day trading the stock market in spite of high frequency algorithmic program trading and the specialists who dominate the stock market. Guess what? Whatever the Internal Revenue says your tax bracket is, that's the rate you get taxed at. But if you trade, let's say, futures, commodities, indexes, and pardon me, currencies, a lot of people don't know this. 60 cents of each dollar's profit is taxed at the low long-term capital gains rate of only 15%. The remaining 40 cents of each dollar's profit is taxed at whatever remains in your tax bracket. Then there's other things like you have uptick rules. You can't go short unless it ticks up, or it needs to be optionable to sell short. There's tons of reasons why the stock market is rife with all kinds of restrictions. It is just so much easier to trade futures and commodities. So I hope you don't be scared off by them. Some people have heard stuff, but they've never tried it. Don't form a judgment until you've tried it. That's why everybody in my course always sim trades it first. And I've trained an 11-year-old boy how to use my system, and he had no trouble at all understanding. He didn't know what futures were, and I never even bothered to explain it. You don't even know what they have to know what they are. So I hope that helped.
Kind of like driving a car.
Kind of like.
Once you, yeah. Chris says, thank you for the presentation. Well done and informative. What do you think keeps students from achieving success?
Keeps them? Oh my gosh. Well, that was
Keeps
the
them
question.
from achieving.
Yeah, that sounds like the question you asked Rick and the other guys at the interviews at the beginning of this
What would
today.
you tell
I'm going
your
to
younger
throw my
self?
opinions in. First of all, I, even though I was a psychotherapist for quite a while, I've been in business also for a number of years before that. And in business, if you're going to make any money, you need consistency. You can't scale up, as Rick was trying to imply. You can't trade bigger size and make more money or double your money. The lacking thing is consistency. This is what you must shoot for. And that is why I am a big advocate of Boolean logic mechanical trading systems. That's a mouthful, but in plain English, it simply means you got to have rules-based guardrails to get into the trade and as much automation as possible once you're in the trade so that you don't let your emotions participate. Once you have that, you will start to develop consistency. That's what I believe will help beginners.
That is a great answer. Oscar was wondering, your win percentage is great, but what is your win-loss ratio? Which is the important thing?
Well, the win-loss ratio is pretty much the same thing. If I won 87% out of every 100 trades, that ratio is going to be however you divide it. Bottom line is, the students in all of the testimonials that I've acquired over the years have been saying, my gosh, I've never had consistency like this. This is what we're looking at. We're looking at consistency while we keep the risk levels low, low, low. Have you ever seen risk levels as low as I disclosed earlier? Doubtful, very rare. And that's because I use logical stops. So with a combination of logical stops, rules-based approach, and all the other things I shared with you, and last of all, the most critical component in the entire course that accompanies the system, it's benchmarking. You absolutely have to benchmark so that you know precisely how well this thing works for you, the human side, with the software. So hopefully that provided what you needed.
Well, he kind of clarified now, risk colon reward ratio. So I guess instead of a
Okay, I
win-loss,
know
it's a
what you're talking
risk
about.
versus
Well,
reward
first of all,
ratio.
it's actually, he's got it somewhat upside down. Reward risk ratio is the way I describe it. About 30 or some years ago, a guy named Brown had a very informative newsletter that basically tracked trading systems. And long story short, he bought every system on the market for a period of time and traded them with real money and slippage and all that business. And he found out, and it's been true ever since then, that the average reward risk ratio, despite claims that people make hypothetically of 2 to 1, 3 to 1, oh my God, 4 to 1 is ridiculous. The average reward risk ratio is at most about 1.25 to 1. If all you achieve is that or a little bit better, and ours is closer to 1.5 to 1, maybe not 2 to 1, sometimes you'll run through good stretches. But here's the thing, I'm also teaching my students exactly how to monitor, because I give them a business plan to fill out, how to monitor whether or not they're going through a rough patch and how to step aside and go back and benchmark again to find out what's wrong and get back into a very serviceable reward risk ratio. So I hope that helped.
And I have Raheem was asking, what do you do differently for swing trading?
What do you mean differently? I mean,
I think you said you could what the thing you said was that it could easily be converted to
yeah, yeah.
swing trading.
It's remember my particular program that includes the software, all the tools, my personal coaching in the coaching room. I prefer coaching room instead of trading room because I'm not trying to pitch here, but it's for day trading. And if anyone is interested in, hey, I want to repurpose this because I'm interested in swing trading also, that should be your secondary motivation, not your primary. If you come to me, you want to be a day trader. But if you want to also learn how to swing trade, you can repurpose a day trade by using sets of 3 contracts, trading futures. First contract, as I said earlier, take off at an easy to reach target. That way, stress is off the table. Paid for trade. Ride that thing with the trailing stop the way I demonstrated earlier, all the way to the close. If you're still in the trade by the time the close occurs, then take off the second position about 5 or 10 minutes beforehand. Don't wait until the close. Never ever exit market on close. That's a big mistake. And then you need to convert the stop on the final third contract or whatever, however many positions you're in. Or let me rephrase that. However many contracts you're trading, the final third of that would be with a good till cancel stop. So you're protected overnight. And the next morning, you would step up to the next higher time frame to give more breathing room for that trailing stop. That's the way I would repurpose. And I, of course, go into more detail if anyone is in my course.
So that leads to the last question that I have, unless anyone has more to ask. Frank is asking, what other platforms does your system work on? Like you said, not on Ninja, right?
I highly recommend Ninja. I've written
Oh,
my personal software for Ninja. I did not write it for anything else because I haven't found anything that can do the things I want,
so
the
only
kinds of
Ninja.
automation. Now, can you use other platforms? Well, first of all, steer clear of amateur platforms like Thinkorswim. I was personal friends years ago with, I think his name was Tom Post, who created it before he sold Thinkorswim to TD Ameritrade. And he admitted candidly at that time it was an options trading platform with some day trading capabilities grafted on. It won't be sufficient. You really need professional software. You may say, well, how about TradeStation? Well, about almost 30 years ago, about 30 years ago, I was one of the original beta testers before it was TradeStation. It was called System Writer. And I stayed with them because I loved it. But then when the Cruz brothers sold it to the Japanese, they stopped improving it. And it doesn't have as many of the features that I can get out of Ninja Trader. So I do not recommend using TradeStation either. Quite frankly, I'm just a big advocate of Ninja Trader. I don't get paid to say it. I just know it works best. So that's my short and sweet answer. I'll take another question because I know we're getting close. Anybody
All
got
right.
one final
I got
question?
two. I got two.
Two.
Cost question, trading room question, and then does it work on Trading View?
No, not on TradingView. I already said what I said. It worked. I mean, you can create what I've taught you on any platform, provided it allows you to. If TradingView permits you to do the things I described, you can watch the replay when you get it later and go into more detail. Or you can arrange to visit with me and I can talk to you then. But uh, Ninja Trader is still what I recommend. And what was the other part?
Pricing for your trading room.
The
Or do I need to put a link in for everybody?
Missed that. Let me take my headset off for a moment so you can repeat that and I'll hear it better. Go ahead.
Let's see. Okay, so I am.
About the trading room.
The cost for your trading room?
Oh, okay. There is no cost. It's part of the whole investment that you make for the system. You get tons and tons of tools. If you go to my website, daytradesafe.com, it's all one word, daytradesafe, and opt in, I will be doing a full-blown, in great detail webinar next week. So if you want to know those
Let me get
details
that link.
and be in touch with me, that will answer that question. But your investment includes the coaching room, as I prefer to call it.
Is it daytradesafe.com/dominate?
Well, there is what I want to conclude with since we only have a couple of minutes left or so.
All right.
For the investment, I want you to know that we even include a payment plan. It's real easy. Here is the link. Copy it down, or maybe Sherry can post it so you can see it
I'm going to
in
put it in
the
the
chat
chat.
window or whatever. It's daytradesafe.com
There you
slash
go.
dominate, as she's already said. If you go to that, don't do it right now. I have more to say. You will see
And I posted in the
a
chat.
description of what you're going to get. Now, I want you to know that some people, they don't want to put it all on the card. They say, I wish I could spread it out. I have made arrangements with PayPal. And then don't worry, I know some people hate PayPal, but don't worry. They'll be friendly with you. They offer an opportunity after a very quick 2-minute credit check. If they love you, they will give you 6 months to pay them back. If you pay them back within 6 months, they won't even charge you a penny of interest. That beats the heck out of any credit card. I highly recommend taking that approach. And I have a link to that in the page you'd go to if you went to Dominate, TradeSafe.com/Dominate. And here's what I want you to know. The normal price, which I'm not going to quote here because I was told to make a soft pitch to quote Sherry. So I'm not going to quote the price, but I am going to tell you what our normal price is, which is in the thousands. We're going to give you a 50% Christmas discount. This is a one-time limited offer. So take advantage of that while you can. So I hope that helped other people.
And we're right on time.
And I want to say thank you to everybody. And I want to say thank you to Traders Exclusive for this wonderful opportunity. Hope to come back in March, do some more. And I want to say thank you to all of you for taking time out of your day to hopefully learn a few things to be consistent in your trading. Bye-bye.
Bye-bye. I got one thing for you to know, though. Chris is here in the room. He said, folks, I bought Michael's course 2 years ago for the 1997. I had life happen and I couldn't complete it. I plan to buy it again and go back to his instruction.
Chris, why don't you get in touch with me and I will make arrangements so you don't have to make the full investment. How's that sound?
There you go, Chris. Now, how should he get in touch with you?
I'm sorry, my other computer is talking. What did you say?
Sorry. How does he get in touch with you?
He can submit a support ticket first to support@daytradesafe.com. Ask any question, and especially if he wants to talk to me personally on the phone, be sure and say, give me a scheduling link, and that link will give you my calendar and show you when I'm really available. And that way we can take up to a full hour of time to answer all your questions. How's that sound?
That's really kind.
Well,
I really appreciate you being here. And yes, sir, I'll be inviting you back again.
I am so looking forward to it. And I want to say thank you to all of you folks. May you trade safely and profitably. Bye-bye.
Yes, thank you. Bye-bye.